Welcome to another deep dive from TalkTickers. Today, we're digging into SUNation Energy's recent Q2 2025 earnings call. You might remember them as Pineapple Energy. They just put out their latest financials. And honestly, it set up this really interesting, almost contradictory picture. Yeah, so on one side, you had management sounding super optimistic, talking up strong operational wins, a clear strategy moving forward. But then you look at the market's immediate take, and it was, kind of lukewarm. Shares actually ended the day down, which is odd after a slightly positive open. Trading was pretty light too. So our job today is to unpack that. Why the gap between a company's story and the market reaction, and what could it all mean for you? Okay, let's start with the basic numbers. SUNation's Q2 2025 revenue came in at $13.06 million. That's actually down 3.6% from last year. And the GAAP EPS, that was negative $3.14. Now, before you get too hung up on that top line, the operational side is where things get, more compelling. Adjusted EBITDA, that improved quite a bit. The loss narrowed to just under $1 million. Navistar, $0.99 million. Last year it was down to $1.69 million.
And management really hammered this point home. It's a key metric for them.
Yeah, what's really fascinating here is just how much progress they seem to have made on, efficiency and financial stability too, even with that little dip in sales. I mean, look at the gross margin. It went up to 37.0%. That's a jump of 160 basis points. And interestingly, if you isolate New York, their margin there was even better, climbed to 40.3%. It really suggests they're getting much better at squeezing profit out of their sales.
That's a really important point. And then the balance sheet. Wow. That was maybe the biggest story. Huge debt reduction. Total debt dropped by 61%.
61.
Yeah, that's $11.7 million gone, bringing total debt down to $7.5 million, which feels much more manageable. Plus, their cash position improved a lot, up to $3.2 million from like $0.84 million at the end of last year. So, for a company that's been navigating some choppy waters, these aren't just numbers, are they? What does this massive debt cleanup really signal about priorities?
Yeah.
Stability.
Oh, it's a massive signal. And frankly, it's a really significant accomplishment. When a company in a tough sector does this, it's not just about saving on interest, though that's part of it. It's like they're rebuilding the foundation. It gives them so much more flexibility, cuts down financial risk dramatically. And it really clears the path for future investment without being dragged down by old debt. To me, it says they're laser focused on long-term health, sustainable growth, not just chasing quarterly sales figures. It properly cleans up the capital stack. Think of all the company's funding sources like layers in a cake debt, equity, etc. By slicing away that expensive debt layer, they simplify things, lower interest costs, makes the whole company less risky, more nimble.
And it wasn't only the debt they cleaned up, right? They also tackled potential dilution, which shareholders always watch closely. They got rid of their Series A warrants. That takes, over 652,000 potential new shares off the table. And they also filed for an at-the-market, or ATM, sales agreement, up to $30 million, working with Needham. So this ATM, it gives them a flexible way to raise capital if they need it.
Right.
How is that seen as more strategic than, say, just doing a big secondary offering?
Yeah, good question. So a traditional secondary offering is usually this big one-time dump of shares onto the market that can really whack the stock price immediately. An ATM is different. It lets them sell shares gradually, drip them into the market over time, only when they like the price and market conditions. It's like having a controlled tap instead of opening the floodgates. This helps avoid big price swings and lets them raise money more efficiently, which is super important for a smaller microcap company where a big sale can really move the needle. It's basically a safety net for funding future growth without rocking the boat too much.
Okay, so operations are tighter, the balance sheet looks much healthier, path seems clear, but then you layer in demand and always policy changes. One really eye-popping number from the call was the backlog growth. Residential backlog just shot up, $35.6 million by the end of July. That's over 31% growth in just 1 month.
Yeah.
Pretty wild.
Yeah, that residential surge is definitely being driven by homeowners trying to lock in those federal tax credits. Section 25D of the ITC, the big residential solar credit, it's sunsetting at the end of the year, so there's this real rush.
Makes sense. Creates urgency.
Exactly. It's pulling demand forward from maybe next year into this year. And the commercial side saw a big jump too. Backlog there was up almost 5 times to $4.2 million by July 31st. They expect to realize about 65% of that commercial backlog by the end of 2025. So yeah, it's a strong sign of future revenue, showing there's still solid demand despite everything else.
Now, policy. Always the elephant in the room for clean energy, isn't it? This one big, beautiful bill act, the OBBBA, passed in July. It apparently tightened up the timelines and rules for clean energy credits. How does a company like SUNation even deal with that kind of shifting ground?
Well, that's the tricky part, isn't it? OBBBA creates this kind of double-edged sword for the industry. On one hand, like we said, it fuels that short-term urgency, pulls demand forward for residential systems under Section 25D before it sunsets. But on the other hand, it definitely adds uncertainty for the longer term because the rules are changing. Management addressed this. They pointed out that while 25D for direct purchase is ending, another section, 48E, still supports residential TPO that's third-party owned systems like leases and their commercial business.
Okay, so it's not a cliff, more like a redirection.
Sort of. It's definitely a shift. And it really highlights how crucial adaptability is in this space. Luckily for SUNation, their diversification helps here. They aren't just betting on one type of sale or one policy. That makes them a bit more resilient.
And speaking of adapting, they're leaning more into leasing and TPO systems, especially in those high-cost markets, New York and Hawaii. That's a shift from their old model, which was more focused on customers buying the systems outright. What's the driver for pushing TPO now?
Well, TPO, the leasing model, basically lowers the barrier to entry for homeowners, reduces that big upfront cost. That's especially appealing in places like New York and Hawaii, where electricity bills are already sky high. The monthly lease payment can look pretty good compared to the utility bill. And this pivot really plays into their core strength, which is that diversification you mentioned. They're not just a solar panel seller. They do residential, commercial, service, even roofing. This mix makes them less exposed if one part of the market slows down. Unlike some competitors who are purely focused on, say, residential sales, it's about building a tougher, more flexible business that can grab demand from different places.
Okay, but the CEO's vision seems to go even bigger, hinting at something that could really change what SUNation is. This is where it gets really interesting. The CEO talked about strategic consolidation, looking at acquiring other diversified energy companies, and specifically mentioned companies involved with AI, crypto mining, and data center infrastructure. Now, that sounds like a massive leap from installing solar panels. What's the real strategy there? It's not just about selling them panels, is it?
Exactly. It's way deeper than just putting solar on data center roofs, although that could be part of it. The real insight, I think, is about potentially owning and managing the energy infrastructure itself. The generation, the storage, the management that these massive operations need. Think about it. AI farms, crypto mining. They need huge amounts of reliable, constant power, and increasingly they want it to be sustainable power.
Right. 24/7 demand. Huge demand.
Huge. So SUNation's experience with big installs, grid stuff, and now this push into TPO models, it positions them potentially to offer specialized energy solutions, maybe dedicated microgrids or power purchase agreements or even building generation right next door, tailored specifically for these energy guzzlers. The logic is clear. AI, data centers, crypto. These are arguably the biggest new sources of power demand coming online over the next decade. And focusing on this aligns perfectly with the high energy costs in their main markets like New York and Hawaii. So yeah, it's not just about solar insulation anymore. It's potentially about becoming a specialized energy provider for the digital economy. That's a much bigger game.
Wow. Okay. And despite all these moving parts, these big strategic ideas, they actually stuck with their full-year guidance for 2025.
Yes, they did, which signals some confidence from their side amidst all this change. They're still forecasting total sales between $65 million and $70 million for the year. That's a solid 14% to 23% jump year over year if they hit it. And maybe more importantly, they expect adjusted EBITDA to flip positive, somewhere between $500,000 and $0.7 million in the black. That would be a major turnaround from the losses they've been posting. The CFO also gave some useful color on how their year usually plays out. Typically, Q1 is slower, Q2 starts picking up, and then Q3 and Q4, especially in New York and Hawaii, he described as off to the races.
Okay.
So they're banking on a strong second half to meet that full year guidance. Hitting those Q3 and Q4 numbers will be really key.
Right. So let's circle back. We've got better operational numbers, a much cleaner balance sheet, these strategic shifts, this ambitious vision for the future. Management painted a pretty rosy picture overall. And yet, the market reaction was negative. Shares closed down over 6%. Thin volume. If the fundamentals are improving and the story sounds good, why the disconnect? What's going on here for you, the listener, trying to figure this out?
Yeah, that divergence. It's actually really common with micro-cap stocks like SUNation. It can be puzzling, but there are usually a few things at play. One is just liquidity. It's harder to buy and sell large amounts of stock without moving the price much in smaller companies. And then you have what you might call capital raise headlines, like that ATM filing.
Even though it's flexible.
Exactly. Even though it's a smart way to manage capital needs, sometimes the market just sees company might sell stock and gets nervous in the short term. This can overshadow the positive operational news, especially on low volume days. It becomes less about the quarterly performance itself and more about how these sort of structural news items are interpreted for a small, less liquid stock.
So it sounds like the company's whole story is shifting from maybe, survival mode, getting through tough times, restructuring, to something more like selective growth, but carefully. They're not just treading water anymore. They're trying to position themselves for a totally different kind of future.
That's a great way to put it. And for anyone watching BackyNation, there are definitely key things to monitor. Catalysts, you could call them. These will show whether they can actually execute on this new narrative. First, obviously, turning that big backlog into actual revenue. The Q3 earnings, expected mid-November, will be huge for that. Second, any real news on potential acquisitions, especially in that AI data center energy space. That's the big, bold bet.
Go see some action there.
Right. Third, how well are they actually doing with the shift to leasing and TPO? Are customers signing up? And finally, any more clarity on how OBBBA policy shakes out, and definitely any updates on if or how much they use that new $30 million ATM facility. Watching those points will give you a much better picture of their real trajectory and whether the market starts to buy into this bigger vision.
Okay, awesome. Now, before we wrap, the standard reminder.
Yep.
This is a hard take for discussion. It's definitely not financial advice. Do your own homework. But with that said, here's an outrageous but plausible trade idea involving SUNation Energy, ticker SUD.
Okay, so the idea. Go long SUNE. The bet is fundamentally on their strategic pivot, specifically their move to provide these comprehensive energy solutions for AI and data centers. Now, the outrageous part, well, yeah, it's a microcap. It's got recent GAAP losses. The stock price has been all over the place, and they're navigating tricky policy waters. Lots of risk there.
Definitely not for the faint of heart.
No. But the plausible part is what makes it interesting. They have cleaned up the balance sheet significantly with that debt reduction. That's real. The backlogs are surging, which points to near-term revenue growth. And maybe most importantly, the CEO has laid out this clear, if ambitious, vision, targeting the fastest growing energy consumers out there, AI, crypto infrastructure. So the bet is really on management's execution. Can they pull off this diversification? Can they actually capture that massive future energy demand? You'd basically be looking at the current market down as a chance to get in early on a potential turnaround before everyone else catches on to the strategy shift and that ATM. While maybe it spooked some investors initially, it actually gives them the financial flexibility needed to potentially fund this big pivot. It's part of the plan. So to quickly recap our deep dive today, SUNation Energy looks like it's pulling off a genuine financial turnaround. Key metrics improving, debt way down. They're adapting strategically, changing their business model with TPO, responding to policy shifts.
And they've presented this pretty compelling long-term vision tied to these huge emerging power demands from AI and data centers.
Right. And, knowledge is always most useful when you think about how to apply it. So connecting this to the bigger picture, maybe the question for you to think about is, how will companies like SUNation and others position themselves to really capitalize on these huge shifts in energy demand from new tech? And what does that mean for the whole energy sector over the next, say, 5 or 10 years? It's definitely a fascinating space to watch.
That is a great question to chew on. And one last time, please remember this deep dive was purely for informational purposes. It's absolutely not financial advice. Always do your own research, look at things from different angles, and make choices that are right for you. Thanks so much for joining us on this deep dive. We'll catch you on the next one.